I made my first $1 million when I was 37 years old. I became a billionaire when I was 75. You want to know what the difference was between the first million and the first billion, between me and all the other supposedly smart people who blew up along the way? It wasn't a secret. I just stopped doing stupid things. That's it. That's the whole game. Everyone, and I mean everyone, is running around looking for the secret formula, the magic stock, the perfect market timing. They're looking for an edge. They're looking for something to do. There is no secret. There is no magic. There is only a short, brutal, unforgiving list of idiotic mistakes. And if you can just avoid them, you don't even have to be brilliant. You just have to not be a fool. You avoid the landmines, and you let compounding do the rest. You win. I have sat at the table with some of the most intelligent minds of the last century. I've watched them, with PhDs and genius-level IQs, systematically destroy themselves. Why? Because being smart is not a defense against being stupid. And these aren't small mistakes. These are errors in judgment that will cost you decades, not a few percentage points. Decades of your life vanished. Today, right now, I am going to give you that list. The 6 fundamental pitfalls that ruin 99% of amateur investors. And I'll tell you this, if you are currently making just 2 of these mistakes, you are already 10 years behind where you should be. So listen closely. The first mistake, the one that infects almost everyone with a brokerage account. Mistake number 1, you are trying to be a genius. You are chasing complexity. This is the single dumbest thing I see people do, and it drives me absolutely insane. You hear about a new technology, quantum computing, gene editing, artificial intelligence, and your eyes light up. It sounds complicated. It sounds intelligent. You think that because it's hard to understand, it must have a massive payoff. That is completely, utterly backward. I am not smart enough to figure out which of the 100 biotech startups is going to cure cancer, and neither are you. The dirty secret is, the people running those companies probably aren't smart enough to know either. It's a gamble dressed up in a lab coat. My approach? I look for the simple things, the boring things. I want a business so simple, so durable, that an idiot could run it. Because sooner or later, one will. I want to be able to explain how it makes money to a 10-year-old. Let me give you the greatest case study in history of geniuses being fools. Long-term capital management, LTCM. In the mid-90s, this was the smartest room on the planet. You had 2 Nobel Prize-winning economists, Merton and Scholes. You had the best traders from Wall Street. They created these impossibly complex computer models to predict the movement of bonds. It was rocket science. And for a few years, it worked. They were hailed as gods. They believed their own hype. Then, in 1998, Russia defaulted on its debt. A little thing, something their genius model said was a 10 sigma event. Something that should never happen in the history of the universe. And their entire leverage to the hilt empire collapsed. They lost $4.6 billion in a matter of months and nearly took the entire global financial system down with them. The geniuses weren't so smart after all. They drowned in a sea of complexity they created. And yet, here you are. You spend 3 hours researching a $50 coffee machine, reading every review, comparing every feature, but you will throw $10,000, your hard-earned money, at a cryptocurrency firm with a 20-page white paper full of jargon you don't understand. All because someone on the internet posted a rocket ship emoji next to its name. It's a profound failure of logic. So here is your rule. It's called the 10-year-old test. Before you buy a single share of anything, ask yourself, can I explain this business, how it makes money, and what its durable competitive advantage is to a reasonably intelligent child? And more importantly, could they then explain it back to me? If the answer is no, you have no business owning it. Here is your homework. Tonight, go through your entire portfolio, one holding at a time. Apply the 10-year-old test. If you cannot explain it simply, you sell it. Tomorrow, I don't care if you're at a loss. Sell your ignorance. It's the best investment you'll ever make. This leads directly to the second pitfall, which is a close cousin to the first. Mistake number 2, you are ignoring history. You think this time is different. Those are the 4 most expensive and most dangerous words in the English language. It's astonishing. People act as if the world was invented the day they were born, as if human nature has somehow been repealed by the internet. They see a stock going up and they call it a new paradigm. Wrong. It's just the same old human psychology. Greed and fear playing out on a different stage. My partner Warren and I, we are not business analysts. We are not economists. We are historians. We spend our days reading about the mistakes other people made. I read about dead people. Why? Because their stories are finished. You can see the whole arc of boom and bust, of brilliance and folly. And you learn that while technology and fashion and politics change, the underlying human emotions do not. What drove a man to ruin in the South Sea bubble of 1720 is the exact same thing that drove him to ruin in the dot-com bubble of 2000 and the crypto craze of today. Let's look at the dot-com bubble. In the late 1990 seconds, all you had to do was add .com to your company's name and its stock would triple. Pets.com, webvan.com. Companies with no profits, no path to profits, were being valued at billions of dollars. And people, smart people, said, this time is different. The internet changes all the rules of valuation. They were wrong. The rules didn't change. Gravity still worked. And when the crash came, $5 trillion of market value evaporated, an entire generation's retirement savings. Gone, because they forgot history. Now look at today. You see some new coin, a new AI company, a new electric vehicle startup that has never produced a car, soaring to an insane valuation. And what do you hear? This time is different. It's the same script. You think you're a modern, sophisticated investor because you're using an app on your phone. But you're no different from a Dutch merchant in the 1,630 seconds paying the price of a house for a single tulip bulb. It's the same mass hysteria, just with a faster internet connection. So here is your rule. It's called the 100-year rule. For any investment thesis you have, especially if it feels new and exciting, ask yourself, has this pattern of human behavior, this level of excitement, this type of valuation, this promise of a new era, appeared in the last 100 years? The answer is almost always yes, and if it is, you are not a pioneer in a new world. You are a character in a very old play, and you should know how it ends. Your homework: go read a book about one major financial mania, just one. Tulip mania, the South Sea bubble, the crash of 1929, the dot-com bust. Read it slowly. And don't just read it as history. Look for yourself in its pages. See your own excitement, your own fear of missing out, staring back at you from across the centuries. That is a truly valuable education. Now, for the third mistake. 1. The financial industry actively encourages. Mistake number 3. You are practicing diversification. You think you're diversifying, but you're just diversifying into ignorance. This is a lie. A complete and utter lie sold to you by Wall Street. They tell you don't put all your eggs in one basket, so you go out and buy 100 different stocks, or you buy a mutual fund that owns 500 stocks. You feel safe. You feel professional. This is nonsense. It's an admission of total incompetence. If you own 50 or 100 different things, you don't really know what you own. You can't possibly keep up with them. You're just buying a little bit of everything, which guarantees you will get average results. At best, and after the fees you pay for the privilege of being average, you're actually getting below average results. It's a loser's game, designed to make the fund managers rich, not you. My philosophy is the exact opposite. I believe in extreme concentration, in the few things I understand best. I want to find a handful, maybe 5 or 10, truly wonderful businesses with durable competitive advantages that I can buy at a fair price. And then I want to own a lot of them. That is how you get wealthy. Putting your best ideas into your portfolio, not your 47th best idea. The case study for this is the entire mutual fund industry. Year after year, the vast majority of actively managed funds run by supposed experts who own hundreds of stocks, fail to beat a simple, low-cost index fund. They are so diversified that they essentially become the market, but a much more expensive version of it. They are diversifying away any chance of outperformance. They are diversifying into mediocrity. And you're doing the same thing. You think you're building Noah's Ark, taking 2 of every kind of company. You're not. You're a hoarder. You're collecting financial junk that you don't understand, and it's weighing down your returns. Your great ideas are being canceled out by your terrible ones. So here is the rule. It's called the hell yes rule. Go through your portfolio. Look at each position and ask yourself this question. If I were starting over today with 100% cash, would I buy this specific stock at this specific price right now? If the answer is not an immediate, visceral hell yes, then it's a no. It's not a maybe. It's not a well, I'm down on it, so I'll wait. It's a no, and if it's a no, you sell it. Your homework is to do exactly that. Perform the hell yes audit on your portfolio. Be brutal. Be honest. You'll probably find you only have 2 or 3, maybe 4 hell yes ideas. That's good. That's your real portfolio. Sell the rest and wait patiently for another hell yes to come along. This brings us to the 4th, and perhaps most behaviorally difficult, mistake. Mistake number 4. You are paying too much attention. You are hypnotized by the ticker tape. This habit, this addiction to checking prices every day, every hour, is not investing. It is gambling, and it is poison. When you buy a stock, you are buying a fractional ownership of a real business, a business with employees and factories and customers. It is a productive asset. If you bought a farm, would you call an auctioneer every morning to get a price quote on your land? Would you sell it if the quote was down 2% from yesterday? Of course not. That would be insane. You would focus on the farm's output, the crops, the soil, the weather. Yet that is exactly what you do with your stocks. You ignore the underlying business, and you obsess over the manic-depressive mood swings of Mr. Market. You're letting a stranger on the internet dictate the value of your assets on a minute-by-minute basis. This makes me physically sick. You are turning a long-term advantage, the ability to be patient, into a short-term disadvantage by reacting to noise. The classic case study is the stock market crash of 1987. Black Monday. The market fell over 20% in a single day. People panicked. They saw the red numbers on the screen, and they sold everything, locking in catastrophic losses. The people who made money, the people who were on vacation, the people who didn't look, the people who owned good businesses and understood that the value of the Coca-Cola company did not fall by 20% between breakfast and lunch. They did nothing. And in a few years, the market had recovered and marched to new highs. You are a mouse in a laboratory experiment. The financial news network is the scientist. The green number on the screen is your dopamine pellet. The red number is a small electric shock. You are being conditioned to react, to trade, to feel something. You are being trained to be a bad investor because your activity generates fees and commissions for them. You are not getting rich. You are providing the exit liquidity for people who are. Here is your rule for this: the vacation test. Could you go on a 2-week vacation to a remote cabin with no internet access and not feel a shred of anxiety about your portfolio? Could you come back after 14 days and not even feel the need to check the prices immediately? If you can't, you don't own your investments, they own you. Your homework: this will be the hardest one for most of you. Delete the stock market app from your phone right now and delete the bookmark from your browser. Commit to checking your portfolio only once a month, or better yet, once a quarter. Break the addiction. Start thinking like a business owner, not a ticker watcher. Fifth mistake. This one is non-negotiable. It's the one that guarantees ruin. Mistake number 5. You are using leverage. You are borrowing money to invest. There are 3 ways a very smart person can go broke: liquor, ladies, and leverage. I don't care how smart you are. I don't care how much of a sure thing you think your investment is. Using borrowed money to buy stocks that fluctuate in value is financial Russian roulette. It means you can be right about the business and still be completely wiped out by a temporary market swing. If you are smart, you don't need leverage. If you are dumb, you have no business using it. It is that simple. Leverage takes away your most valuable asset, your staying power. It introduces a ticking clock. It puts you in a position where you can be forced to sell at the worst possible moment. It turns a temporary problem into a permanent loss. The landscape of financial history is littered with the corpses of brilliant people who were destroyed by leverage. We already talked about LTCM. They were leveraged about 100 to 1. More recently, look at Archegos Capital Management in 2021. A man named Bill Hwang, a supposedly brilliant investor, used massive amounts of borrowed money from big banks to make concentrated bets. When a few of his stocks went down just a little, the margin calls started. He was forced to liquidate his entire portfolio, tens of billions of dollars, in a matter of days. He wasn't just ruined, he vaporized, all because of leverage. You sit there and think, Well, that's a billionaire. I'm just using a little bit of margin from my broker. It's the same principle. You wouldn't play Russian roulette with a gun that has 100 chambers and only one bullet. So why are you playing it with a gun that has 6 chambers? You're betting your entire financial future, your family's security, for the chance to make a few extra percentage points. It is pure, unadulterated madness. The rule here is simple, the zero debt rule. Your investment portfolio must have zero margin debt, ever, under any circumstances, period. Your homework, if you have a margin loan, no matter how small, pay it off. Today, sell whatever you have to sell to get back to zero. The peace of mind you will gain is worth more than any potential return you could ever get from that borrowed money. You need to be in a position where you can survive any market storm, and you cannot do that when you owe someone else money. Finally, the 6th mistake. This is the one that lies underneath all the others. Mistake number 6. You are overconfident. Your ego is writing checks your portfolio can't cash. You think you're smarter than everyone else. No, you are not, and neither am I. The single most important intellectual quality for an investor is not brilliance, it's humility. It is a deep, abiding, and terrifying awareness of your own ignorance. Knowing what you don't know is infinitely more valuable than what you do know. The world is a complex, dynamic, and often cruel place. The market is the sum of millions of people's hopes, fears, and calculations. To believe you can outsmart that system consistently is the height of arrogance. And it is always, always punished. Look at Enron. They were famously the smartest guys in the room. They hired from the top business schools. They created markets that were so complex, nobody outside the company could understand them. And investors, believing they were smart enough to ride along with the geniuses, poured money in. It was all a fraud, a house of cards built on ego. When it collapsed, it took thousands of jobs and billions of investor dollars with it. The people who were humble enough to say, I don't understand this, so I will avoid it, they were saved. You have 1 or 2 good trades. You pick a stock that doubles, and suddenly you think you're a Wall Street titan. You start giving advice at cocktail parties. That is the most dangerous moment in your investing career. That's like a squirrel finding a big nut on the ground and thinking it's a master hunter. It wasn't skill, it was luck. And if you confuse the two, you are doomed. So here is your final rule. The circle of competence. Take a piece of paper and draw a circle. Inside that circle, write down the industries, businesses, and ideas that you understand deeply, better than almost anyone else. For most people, that circle is very, very small, and that is fine. Your job as an investor is to stay strictly, religiously, inside that circle. It is not a sign of weakness to admit that you don't understand something. It is the ultimate sign of discipline and strength. Your homework, make that list. Write down your circle of competence, and then write down a much longer list, the anti-circle, the list of all the things you will never invest in because you do not have an edge. Biotechnology, complex derivatives, geopolitical commodity plays. Be honest about your ignorance. That list of things to avoid is more valuable than any hot stock tip you will ever get. So there you have it, the 6 pitfalls. Avoid complexity, study history, reject diversification, ignore the daily noise, flee from leverage, and cultivate humility. That's it. That's the whole game. It's not about being a genius. It's about consistently, methodically, and patiently avoiding stupidity. This path will not make you rich next year. It won't give you a great story to tell at a party, but in 20 or 30 or 40 years, when all the gamblers and the geniuses have blown up, you will be the one left standing. You'll be the one they come to for a loan. You know, most people have already clicked away from this. They got bored. They left to go search for the top 5 stocks to buy now. Good. Let them. This advice isn't for them. If you're still here, it means you're serious. It means you're willing to do the hard, boring work that actually builds wealth. This channel, my work, is not about hype. It's not about predictions. It's not about making you feel smart. It's about giving you the timeless, battle-tested principles for not going broke. If that's what you want, you know what to do. I'm done here. Now go do the boring work that makes you rich.